Hi, I'm David Witter, founder and CEO of Financial Harvest Wealth Advisors. Excited to be with you today to talk about some changes coming in the near future with Social Security, but more importantly, how to cope with that effectively and set up your retirement with 3 strategic income sources to help you mitigate taxes. So let's jump in. Wall Street Journal article just came out a few days ago. Social Security is expected to dip into their trust fund this year, which is sooner than they expected. And they expect the $3 trillion trust fund to be depleted by 2034 and also Medicare Part A to be depleted in 2026. This means they're basically running out of money unless they change some things. So, first thing is what to expect, or how can you anticipate this and be ahead of it? What can you expect? A couple things here. Maybe they reduce the benefits in the future. Maybe they make you wait longer to full retirement age. Maybe they change the cost of living adjustment or take it away. Or maybe there's higher taxation on earnings as you're earning it, or maybe there's higher taxation on the benefits in the future. Or maybe Social Security becomes means tested. Whatever it may be, know that we'll be watching this closely, and as soon as we have information from Congress or any changes here, we'll pass it on to you and how to cope with it effectively. But today what I want to focus in on is that traditionally people have thought about 3 retirement income sources. And here you can see that traditionally they thought of Social Security as one leg of the 3-legged stool, pensions as the second leg, and then their personal investments for the third leg. Well, no new news here. The problem is Social Security and pensions are becoming something of the past. You just can't count on them like you used to be able to. So what do you need to be doing today to plan for successful and safe retirement? I like to think of it as calling it the strategic 3 income sources. So let's take a look at each one of them. The first one that would be your pre-tax or your 401k bucket of assets. You put it in tax, you got a tax deduction when you put it in, but remember on the back end when you take it out, it's fully taxable to you. The second bucket would be Roth, which is tax-free. And then the third bucket would be non-retirement investment accounts, which again has a little bit different tax treatment. So let's look at each one of them and how they all come together. With the pre-tax, remember it's taxed at ordinary income brackets. So you can see here it ranges anywhere from 10 up to 37%. So if you're taking out from an IRA or 401k, you could pay as much as 37% taxes on the distribution. The second category, we all love this, would be Roth. No income taxes on those distributions. And remember, Roth accounts don't even have required minimum distributions. So you can leave it in there all the way through the entirety of your life if you chose to. And then the third type, it would be investments that are non-retirement accounts. So the principal, the original money you put in, you would pay no tax on, but you might pay some tax on the dividends and the capital gains, and you can see that's going to range anywhere from the 15 to the 23.8% rate on the gains and the dividends. So how do we put all this together? The way I like to think about it is as you transition to retirement, and we're doing this with our clients, you can have one bucket which is IRA, which is pre-tax, one bucket is Roth, and then one bucket is non-retirement. And imagine that you can turn on 1, turn on 2, or turn on 3 at different degrees to custom tailor your income in terms of how it's going to be taxed. Think of the power of that. Here I drew a little funnel. So imagine as the income is coming out, it's going to funnel away some of the taxes. But look over there on the bottom right. Notice that the bands of income, as you go up in income bands, more and more subject to taxation. So by throttling the different faucets within the different 3 types of retirement accounts, you can actually aim where you come in here to a certain degree on the tax tables. This is what we call strategic planning when it comes to your 3 retirement income sources. All right, so what's the dominant strategy? What do you need to be doing now? Number 1, anticipate some changes coming in Social Security. The numbers and the demographics just are going to force that. Number 2 is build the 3 types. Pre-tax, Roth, and non-retirement. If you have capital in all 3 of those, it gives you a whole lot more flexibility to do the tax planning and aim your income to be tax efficient when you get into retirement. Number 3, exploit the tax law changes. We're in one right now. This is a great opportunity to be meeting with your wealth manager to talk through those and how to set up those 3 accounts. And the last but not least is make sure you have your expert team that are communicating. Expert team, remember, estate plan attorney, CPA, wealth manager, to make sure they're communicating cohesively to take care of your plan and make sure you have a successful retirement. If we can give you a second opinion if you're not a client, give us a call If you are a client and want to work through any of these, let us know, and we'll set up your 3 strategic retirement income sources to give you a successful retirement.